Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and I'm pleased to welcome you to today's webinar presentation that's being brought to you in conjunction with QuantInsti. Today, the topic is actually we're doing part 2 of managing complex option portfolios and simplifying option Greeks. I'm very pleased to have Rajiv Vora, who is the director of or actually the founder of iRage Capital Advisory, and also a director with QuantInsti covering options-related information. So with that, I'm very pleased to welcome Rajiv. So Rajiv, what I'm going to be doing now is actually putting, let me make sure that I can pass the controls over to you so that we can go ahead and get underway. Please unmute your phone, and let's go ahead and get started here today. Thanks for joining us, Rajiv. Welcome.
Hi, hello everyone. Can you hear me?
I can hear you fine, and now I'm able to see your slides. So I'm going to mute myself. Take it away, Rajiv. Thanks.
Yeah, thanks, Cynthia, for organizing it and organizing this event, and then for the wonderful introduction and coordinating with everyone. So thanks a lot. I'm not sure how many of you had attended the first webinar a month back, in which we had looked at 2 of the Greeks in a lot of detail. So we had looked at delta and gamma. So we had looked at how delta of options change with regards to things like time, volatility, change in the underlying price, and so on. Likewise, we had looked at how gamma of options change with regards to changing market characteristics like volatility, future expected volatility, time to expiration, price of the underlying, and so on. So today we are going to look at the rest of the Greeks, which are Vega, Rho, and Theta. So last time we had looked at the second derivatives as well, and when we looked at the derivatives of gamma, so those were the third derivatives as well. So today we are going to do something very similar for Vega. Okay, so sorry. As most of you would be aware, Vega of an option denotes the sensitivity of the option with regards to volatility. So basically, if you remember, the Black-Scholes option pricing model, or any option pricing model for that matter, there are 5 key inputs, and then there are a few more. So the 5 key inputs being price of the underlying, the strike price, the time to expiry, the interest rate, the volatility of the underlying from today's date to the date of expiration. So these are the 5 most critical inputs to option pricing. In addition to those, you have, if you're using Black-Scholes, in addition to those, you have other inputs as well, like the dividend, the stock lending and borrowing rate, and so on. Okay. Now, since the price of an option is dependent upon the volatility as one of the 5 key factors, therefore, being able to understand how this relationship works, how the price of options change with regards to volatility, is going to be critical. It's going to be especially critical because of all the inputs that you have to the option pricing formula. Everything else is actually a known input. So if you look at time to expiry, well, everyone knows what is the true time to expiry. If you look at the price of the underlying, everyone knows what is the price of the underlying. The strike of an option is known by definition, because an option is defined based on a strike. So price of the underlying, time to expiry, interest rate, all these are known inputs. The only unknown input is how much volatility is going to exist from today till expiration. So therefore, option pricing often becomes trading volatility. So it's basically my viewpoint on what is the volatility going to be in the future versus your versus the other counterparty's viewpoint as to how the volatility in the underlying is going to be. So based on so basically, when 2 people trade options against each other, because the rest of the inputs in the option pricing formula are known to everyone, therefore what they are in essence trading is the volatility, expected volatility in future. That is the one characteristic that everyone is trading. And that's why you would see that some senior advanced option traders, they would say that when you ask them the price of an option, they would not tell you the precise price in dollars or euros or yen or rupees or any currency. A lot of them would say that, hey, I'm buying this at 21% annualized volatility, I'm selling it at 22% annualized volatility. That's because trading options is actually, in essence, trading volatility. Okay, because trading options is, in essence, trading volatility. And amongst all the simpler products that you have on the exchanges, this is the only instrument that you can have to express a viewpoint on volatility. So assume you want to express a viewpoint on how the volatility is going to be in the future. So basically how crazy the prices are going to be in the future. So this is the options are the only instrument using which you can express your viewpoint on volatility in the future. So therefore, Vega becomes one of the most critical Greeks when you're looking at analyzing options. Okay, so first things first, how do you think Vega of options are linked to the price of the underlying? You have the answer in front of you in a graph, but how do you think, why do you think Vega of options change with the price of the underlying? So let me use a whiteboard. Now say, okay, without even using the whiteboard. So now assume that the underlying is priced at 100. And you have an option with a strike of 120 and another option with a strike of 80. Now, how will Vega affect both of those? Assume both of them are calls. So this is how the payout diagram of calls will look like. Now, if this is where the underlying is, if volatility increases, your upside is also going to increase, your downside is also going to increase. But if volatility increases beyond the point, if volatility increases to this much, the range of, so what I'm drawing is the payout diagram of a call option. These are the strikes. So say the strike is 100, the underlying is currently at 120. Now when the volatility is very low, the range of prices at which the underlying could end would be very low, and therefore you have a possibility of making some money or a possibility of losing money. So therefore, at low volatilities, there is no benefit that you get. But if the volatility is really high, in which case, say the range of values of the underlying becomes like this, in which case your downside gets capped here, your upside can just keep increasing. When you increase volatility, the upside will keep increasing. The downside will also, the range of values on the downside will also keep decreasing, but then this is capped. So therefore, what we have is, as volatility increases, the price of options increase. So therefore, beyond a certain point, as volatility increases, the price of options increase. So this is what you see here. Beyond a certain price, okay, so that was the, beyond a certain price, the price of an option increases. Likewise, you could also look at the case of an out of the money option. So say this is a call with a strike of 100 and assume the market is right now at 80. So if the volatility is less, then the this would be the range of prices at which the underlying would possibly end by expiry. So in both cases, the payoff is going to be negative. So therefore, increases in volatility would not help at the initial stages. But beyond a certain point, increase in volatility would mean that you would make profits on the upside and then the downside is capped. So that is what you see here. An out of the money option. So initially, increase in volatility doesn't increase the price, and then beyond a certain point of time, the increase in volatility increases the price of options. For at the money options, this is what you have. When you increase volatility, the upside keeps increasing. The downside is always capped, floored. So therefore, increase in volatility for at the money increases the price of options. Okay, so this graph is actually slightly different, so sorry for that. So this graph says what is for a constant given value of volatility. So in this case, I used 20% annualized volatility. So for a constant given value of volatility, how does the Vega of an option depend on the price of the underlying? So it could also be explained using the same explanation that I gave. The more the underlying gets at the money-ish, the higher is the impact of volatility on the option price. So this is what it means. So if the underlying is at 80 and volatility will probably increase the range of prices of the underlying to this, but it would still be not good enough for the option to be worth in the money. Now, if the underlying grows up, then increasing volatility would mean that the price of the option could become in the money. The price of the underlying would become in the money, and therefore the option could have a value. So that is what this graph means. So this graph says that the Vega of an option is highest at the money, and it decreases on both sides. So this graph, in essence, says the Vega is highest at the money and reduces on both sides. So basically, when the underlying is at 110, the 110 call will have the highest Vega. When the underlying is at 100, the 100. So when the underlying is at 100, the 100 call would have the highest Vega. When the underlying is at 90, the 90 call will have a higher Vega than the 100 call, which will in turn have a higher Vega than the 110 call. Likewise, when the underlying is at 110, the 110 call will have a higher Vega than the 100 call, and then the 100 call will have a higher Vega than the 90 call. So that is what it means. Okay. So the first question to all of you guys: how do you think Vega changes with time to expiry? So assume anyone has answers to this? Okay. So to be able to answer this, so what I typically advise people, I tell them that, hey, instead of trying to figure the answer out through first principles, through mathematical derivations, what you should, the best and easiest way to do it is try to imagine extreme conditions. The scenario when you have, say, 20 years left to expiration versus the scenario when you have just, say, 1 second left to expiration. In case you have 1 second left to expiration, even if the future volatility of the underlying increases by 1 percentage point annualized, in terms of the price change of the underlying that could happen in that 1 second, it would be very less. Okay, so let me repeat once again. How do you figure out how does Vega change with time? So basically, we are looking at the second derivative, which is how does change in option price with regards to change in volatility affected with time? Is the change in option price with regards to volatility higher at the start of an expiration or lower at the start of an expiration? So does it increase as we go towards expiration, or does it decrease as we go towards expiration? So an easy way to do it is look at, imagine two scenarios when you have 2 years left to expiry, and even if the annualized implied volatility increases by 1 percentage point, what it means is that the underlying is going to be more volatile on each day from today till the end of 2 years when the option expires. So therefore, the eventual range of values of the underlying is going to be much higher. If the eventual range of values of the underlying is going to be much higher, then you would want a higher premium for that option. So basically, this is what it means. This is the payout of a call option on expiration. If you have 1 second left to expiry, the range of values of the underlying is going to be like this, in which case your upside is capped. If you have 2 years left to expiry, the range of values of the underlying is going to be much higher, in which case your upside is very high, and then obviously your downside is always capped, which means that if volatility increases and then you have a lot of time left for expiration, the fact that the underlying would be much more volatile and then could move around much more on each day, each moment till the date of expiration, means that the eventual range of prices of the underlying could be higher, in which case the eventual upside would be way higher, in which case the price of the option will go up. Therefore, as time to expiry, when time to expiry is high, Vega is high. When time to expiry is very low, Vega becomes insignificant. Now, let me use some deductions that we did in the last session in August. So we figured out that when time to expiration is low, gamma becomes extremely high for at the money. But likewise, theta change also becomes extremely high at the money close to expiry. And now we see that close to expiry, Vega becomes insignificant. And far away from expiry, Vega becomes significant. So basically, option trading is about trading Vega far away from expiry, and it's about trading gamma and theta very close to expiry. So very close to expiry, the price of the underlying is very critical, and that impacts the price of the options in a big way. And then very far away from expiry, the future volatility of the underlying is much more critical, because that affects the price. Range of values of the underlying on a daily basis, and then that affects the potential upside in a big way. Therefore, far away from expiry, trading options is all about trading volatility. So this is what we have in terms of a graph. Now, how do you guys think the price of options, the Vega of options change with regards to changing volatility? How do Vega of options change with changing volatility? Well, remember in the last session, we looked at the sensitivity of delta to time and volatility. We looked at the sensitivity of gamma to time and volatility. What we figured out was that if you have high time, a lot of time left for expiration, it means that the underlying has more time to move around, and therefore could have a very wide range of values on expiration. If you have high volatility, an underlying has a characteristic of having high volatility, it also means by nature the characteristic of the underlying is such that it moves around a lot. So high volatility means the underlying will move around a lot. More time to expiry means the underlying has more time to move around and will therefore move around a lot by expiration. So therefore, in a lot of cases, when you need to figure out how a particular Greek will behave with regards to volatility, what you can do is you can try to figure out how the Greek would behave with regards to time, and then the behavior with regards to volatility would, in a lot of cases, be very similar to the behavior when you're close to behavior with regards to change in volatility. So therefore, change of Vega by volatility, most of you would have guessed already. This is how it is. You would have seen that it's very similar to Vega versus time, but for at the money, Vega versus volatility is not the same as Vega versus time. For out of the money and in the money, Vega versus time and Vega versus volatility are similar. Why is that so? It's because it's the way Vega is defined as 1% change in volatility, the change of option price for 1% change in volatility. So basically, let's do a diagram once again. This is the payout of a call. Range of values when the underlying has an 8% volatility. Range of values when the underlying has a 9% volatility. Increase in upside when volatility increases by 1% at 8%. Likewise, range of value when the underlying is at 21%. Range of values when the underlying is at 22%. Increase in upside when the underlying has a 1% increase in volatility from 21 to 22 is the same as increase in upside when the underlying has an increase in volatility from 8 to 9, 21 to 22. So for at the money, the change in Vega with change in volatility is almost negligible. As you can see, it's only beyond a certain volatility that the options get certain Vega. So what it means is, if it's an out of the money option, if the Vega increases from 8% to 9%, it's not going to help. As long as the Vega doesn't, implied underlying volatility doesn't go beyond 20% or whatever. So, and beyond a certain point, the upside and downside, the increasing upside is always constant, and the downside is already capped. So therefore, this also tapers off. Okay, so since we are on the topic of Vega, and then I mentioned that Vega is the most critical Greek. So let us look at concepts like trading volatility. How do you trade volatility? So there are some advanced concepts like variance swap and forward volatility. So let us just look at those two concepts today, probably because it's better to get into one topic in detail rather than looking at 10 different topics. So what is variance swap? So assume you want to make a viewpoint about how the volatility of the underlying is going to change in the future. So you say that today people expect the volatility of the underlying to be 21%, but then you feel that tomorrow there's going to be a big news, or that there are going to be events in the future which will make the underlying much more volatile, or the other way around. So if you have such a viewpoint, you would want to take a position in volatility. So you would want to take a position which makes money if the volatility increases, and which loses money if the volatility decreases. Say you have a viewpoint that the volatility of the underlying is going to increase. Now how do you take a position? Well, if your portfolio has positive Vega, then if the volatility of the underlying increases, if the volatility of the underlying increases and you hold your position till expiry, then you are going to make money, number one, because your portfolio has positive Vega. Number two, if your portfolio has positive Vega and the people's expectation of volatility in the future increases. So there are two things here. If you hold the position till expiry and then the volatility of the underlying actually becomes higher, you make money. Or if you hold the position, but then even before expiration, if the perception of other market participants change, and then they expect volatility to go up, in that case also you will make profits. But then when you initiated your position, you possibly had a positive Vega in your portfolio. Say, for example, the underlying is at 100, you bought 100 calls, 100 puts, and then you had a positive Vega portfolio. But you were correct about your future expectation of volatility. The underlying did become way more volatile. But say it moved to 80. Now, remember from this graph, when the underlying is at 80, the 100 call will have hardly any Vega. And when the underlying is at 80, the 100 put will also have hardly any Vega. By the way, like we discovered for gamma, the call and the puts have the same Vega, same gamma. Likewise, the calls and the puts with the same strike have the same Vega. So a 100 call will have the same Vega as a 100 put. And a 110 call will have the same Vega as a 110 put, but not the same as 110 call, by the way. So based on these diagrams, we see that if you bought calls and puts to get a positive long Vega exposure, when the underlying was at 100, you were happy with a long Vega portfolio. You said that, hey, I feel that the volatility is going to go up. I have a long Vega position. The market is at 100. I bought calls and puts, and then I have long Vega position. But say the underlying moved to 80. Now your portfolio Vega is close to negligible. So why is that so? Because you have positions in 100 call, and then 100 call, the Vega of 100 call when the underlying is at 80 is very minuscule. Okay. So what you need to do is you need to take positions across the entire chain. So you buy 80 call, you buy 90 call, you buy 100 call, you buy 110 call, and so on and so forth. And then you buy it in such a way that your overall Vega exposure is constant across underlying prices. So what do you do? 80 So if you just buy one option, 120. If you just buy one option, this is how the Vega of the portfolio is going to be. Sorry. When the market moves from 100 to 80, your portfolio will not have any Vega. But if you buy multiple options, the summation of which will be a portfolio with a Vega characteristic like this. So this is known as, this concept is known as variance swap. So what you do is, if you see from this graph, the Vega of an 80 call, when 90 call, when the underlying is at 90, is much lesser than the Vega of the 100 call when the underlying is at 100. So therefore what you do is, you buy more of the 90 call so that this would be higher, and then you buy less of this 120 call so that this would be lesser, and then the eventual surface will be flat. So the ratio that in which you do this is actually 1 by k squared. So the derivation of this is slightly beyond the scope of this webinar. So you just have to take it for granted that if you want a pure exposure to volatility, what you need to do is buy options in the ratio of 1 by k square, where k is equal to strike. So if you want, when the underlying is at 100, the number of options that you will buy, 80 calls that you will buy, is to number of 90 calls that you will buy, is to number of 100 calls that you will buy, is going to be in this ratio. So in this ratio, you will buy options so as to be able to have a portfolio Vega which is going to be indifferent, which is going to be constant wherever the market is. Even if the market goes here or here, the portfolio Vega is going to be constant. So what you do, this is known as a concept, this concept is known as variance swap and so on. So you build a chain of positions with the positions in the ratio of 1 by k square, where k is the strike of that option. Okay, so if you do that, your viewpoint about volatility, your viewpoint about you are trading a viewpoint on volatility, because your Vega is indifferent to where the market is. Okay, so now let us look at something slightly more complex. Say you have positions in 3 different expirations of the same underlying. Say you are trading S&P 500 options, and then you have a port for the options expiring in this month, you are net long 30,000 Vega. For the options expiring in the next so say for S&P options expiring in month 1, your total exposure is 20,000 Vega. In month 2, you are short options, and then your exposure is 40,000 Vega. In month 3, the options that you have give you a total exposure of 30,000. So therefore, you have positions in options expiring in 3 different months, M1, M2, M3. When you, for all the positions that you have in options expiring in month 1, when you sum the Vega of those options multiplied by the portfolio position that you have, you get the portfolio Vega. So when you get the portfolio Vega for all options expiring in month 1, say you have a Vega of plus 20,000. For all options expiring in month 2, it's minus 40,000. And for all options expiring in month 3, it's plus 30,000. Now tell me, is an increase in volatility good for you? Is an increase in volatility bad for you? Okay, so because I had jumped so quickly, so people had questions regarding what was the concept known as. So let me just type and send to everyone, variance swap. Okay. Okay, so now for this question, if the if your portfolio Vega for M1, M2, M3 are of this nature, so how is an increase in volatility good for you or is it bad for you? Well, the first thing that you have to do is you have to give different weightages to different expirations. So you need to say the options expiring in month 1 for that Vega is not comparable to the Vega of options expiring in month 2, because change in implied volatility when the time is less is different from change in implied volatility when the time is higher. So you give different weightages. So there are various methodologies to give weightages. So what are the various ways to give weightages? Well, one is the heuristic methodology, wherein you look at how does the change in implied volatility happen when the time to expiry is 1 month versus how does the change in implied volatility happen when the time to expiration is 2 months. So you said that when there are 2 months left to expiration, the change in implied volatility is probably half the change in implied volatility when the time to expiration is 1 month. So in which case, the Vega for month 1, you would multiply that by a factor of 1, and then the Vega for month 2, you would multiply that by a factor of half, because the volatility when there are 2 months to expiration is half that of volatility when the time to expiration is 1 month, say. So one is based on historical observations. The second methodology is based on a formula-based methodology where you multiply it by 1 by root t. So say you do all of those. You could have 2 different portfolios. You have minus 20,000, plus 40,000, and minus 30,000. So based on the weightages that you give, say the combined Vega. So this is monthly Vega. This is monthly Vega. This is the combined Vega based on weightages. So say this turns out to be 0. If this turns out to be 0, this will also turn out to be 0. Now, both of them are the complete opposite of each other. Both of them are the complete opposite of each other. So, which one is good for you? Which one is bad for you? How do you make this decision? Well, you need to ensure either you are this, which is combined 0, or this, which is also combined 0. But then one of them is going to make you money, one of them is going to lose you money. So how do you make this decision? Well, the first thing that you need to do, you need to compare the IVs of each of those. So if this is already trading at 100% volatility, and this is trading at 5% volatility, and this is trading at 100% volatility, then I would expect that probably this will go up. And this would go down. In which case, I would take this portfolio. But in real life, it's not as simple. Say this is trading at 21% implied volatility. This is trading at 23% implied volatility. This is trading at 24% implied volatility. Now, how do you make the same decision? It's not as evident as 100, 5, and 100. These numbers are way more closer. So how do you do that? Let me look if people have some questions. Okay. So all good. Nice. What you need to do is you need to look at, now what is this option? The 23% for month 2. 23% for today till month 2 is 21% from today till month 1 plus something between month 1 and month 2. So basically, you have 21% volatility in the underlying from today till end of month 1, and you have 23% volatility from today till end of month 2, which means this 23% is equal to, so M2 vol is equal to M1 vol plus M2 minus M1, that duration between end of first month and end of second month vol. No, it's not a summation, but then I'm just trying to give you an idea. Basically, the vol component has two components. It's not summation, it has two components. So basically, the first component is 21%, which we already know. This is 23%. We don't know this. So it's just a mathematical equation, so which is actually very simple, but then I think it's slightly beyond the scope of this webinar. So I'll leave it there. And you do a mathematical equation, you get this value. So what you do now, let's go back to this slide. You say, what is the month 1 vol? What is the month 2 to month 1 vol? Which is the volatility between the periods when month 1 ended and month 2 ended. You calculate what is the month 3 minus month 2 vol. Now, if you're trading the month 2 options, in a sense, you're trading this value. Because if you're saying that, hey, month 2 vol options look cheap, what does it mean? It means, it could either mean that this is less or this is less. If this part is less, then you might as well trade month 1 options. So therefore, when you say M1 vol is low, M2 vol is low, you either mean that this is low or this is low. Now, if this is low, then you would rather trade M1. So therefore, you should trade M2 options when this is low. So what it means? It means that when you're trading options, you need to look at the volatility for the forward period between the date when which the previous option expired to this expiration. So this concept is known as forward volatility. So you can get a lot of material on the internet as well. And so basically all it means is when you're trading options expiring in month 2, you should rather trade, your decision should be based on the forward volatility between M1 and M2. If that is low, you should buy M2 options. If that is high, you should sell M2 options. If you feel that it is relatively higher compared to M1 options, then you should sell M2 and buy M1 and so on. Okay. So if you do the QI EPAT lecture, there is actually a very detailed presentation on it, and with a lot of those derivations and so on. So I believe that for today's session, it would be too quick, too short to be able to do that. So therefore, I have just used the very basics. Now, one more thing. Why would you want to trade forward volatility? What are the benefits? Remember, if today is I think the 11th of September. Now, if the options expire on 30th of September, the first month, and then the options expire on 31st of October, the next month. So when you're calculating forward volatility today, you are basically calculating the people's expectation of volatility between 30th September and 31st October. So one set of options expire on 30th September, another set of options expire on 31st October. So basically the forward volatility that you have is measuring the amount of volatility that would exist between 30th September and 31st October. Now tomorrow on 12th of September, you try to do the same thing. What are you measuring tomorrow? You are again measuring the same thing, the forward volatility between a 31-day period starting from 30th of September to 31st of October. You do it on 13th of September, is the same thing. So basically, you're comparing apple to apple and orange to orange. So you're comparing how did the forward volatility from 30th September to 31st October change across dates. What was that value on 11th September? What was that value on 12th September? What was that value on 13th September? And so on. Now, what is the beauty of that? Well, if you were looking at options in isolation and not looking at forward volatility, you would be looking at what is the volatility of options expiring on 30th September and what is the volatility of options expiring on 31st October. You are not using, say you are not using forward volatility, in which case, you cannot compare them because on 11th September, the time to expiry for options expiring on 30th September was 19 days. And time to expiry for options expiring on 31st October was 50 days. On 12th September, sorry, On 12th September, the time to expiry for options expiring on 30th September is 18 days. So you cannot compare the price of the options expiring on 30th September, the price and volatility that existed today versus the price and volatility that exists tomorrow. So if you can't compare that, you can't do anything. So you would say, hey, instead of 30 days to expiry, it has become 29 days to expiry, and then it has become 28 days to expiry. So how can I compare each of those factors? So it becomes difficult. Not just that, when you're trading a lot of expirations, you would potentially have a lot of expirations whose expiration date differ by exactly 1 month. If they differ by exactly 1 month, it would mean that you could compare one forward volatility to another, and so on. So basically, you are trading precisely the volatility implied for a particular month and not all the volatility. So if you feel that M2, M1 volatility is higher, you sell M2, buy M1. That's it. So these are the benefits of using something known as forward volatility. Okay, so let me see if there are any questions. So someone by the name, okay, so say that can I download the presentation? For sure. Okay, so now let's get to something known as theta. Okay, so now theta measures how much the price of options change with change in time. So how do you think theta would change with time? When would theta be highest? When would theta be lowest? So I already have the graph in front of you, but obviously you would not want to just look at the graph and answer it. You would want to know the logical reasoning, the way this was derived. How do you feel? How do you come up with the fact that the graph looks like this and nothing, not something else? Well, the first thing, as I always mention, if you want to figure out how a particular graph changes with a certain metric, what you need to do is you need to take two extreme examples of that metric. Two cases of that extreme cases of that metric. So assume that there is 10 years left to expiry versus there is only 2 days left to expiry. So when you go from 2 days left to expiry, from 2 days to expiry to 1 day to expiry, how is the time value of options going to decrease? Versus when you have 10 years left to, plus 10 years left for expiration, and compared to when you have 10 years minus 1 day left to expiration. So when you have 10 years left to expiration, you hardly care. The time value is definitely going to be huge, but then the change in time value, which is theta, the time value is going to be very high when the time to expiry is high. So time value is definitely very high when time to expiration is high. But the theta will be much lesser when you have 10 years left to expire. You hardly care whether it's 10 years, whether when time changes from 10 years to 10 year 1 day, or 10 years minus 1 day, or 10 year minus 1 month. In all cases, the time value is mostly going to be almost similar. Whether it's 10 years, or 9 years, 11 months, or 9 years, 10 months, the time to expire, the time value is almost going to be similar. But when you have 2 days left to expiration versus 1 day left to expiration, the time value is going to decrease drastically. Isn't it so? So when you have 2 days left to expiration, you would want to price in random moves for the next 2 days. When you have 1 day left to expiry, you would want to price for random moves only in the 1 day. So therefore, the time value of options will decrease drastically. So therefore, theta is going to be an extremely negative number when you're very close to expiry. So it's taken as negative by definition by a lot of people, because theta generally means when you buy an option, you generally lose money which time. Therefore, theta is denoted with a negative symbol sign. Now, in contrast, also you see that the theta becomes extremely huge, close to expiry for at the money, but then for in the money and out of the money, it actually reduces. You can also answer that. So say when you have 2 days left to expiry, underlying is at 100, would you pay any time value for the 80 put? It depends on the volatility of the underlying, but then if the volatility of the underlying is very low, you might not want to pay any time value. If you're not paying any time value for the out of the money put, 2 days left from 2 days from expiry, you will definitely not pay any time value 1 day from expiry. So basically, the change in time value is 0 because the time value itself is 0. So basically, as you come closer and closer to expiry, in the money and out of the money options lose time value. And when they have hardly any time value left, you are not going to lose time value because the time value itself is less. I hope you get it. It's easy to understand for out of the money. So when the underlying is at 100, there is hardly any probability of the underlying ending up below 80. So therefore, the time value of an 80 call, 80 put is low. But likewise, when the, how do you explain in case of in the money? So if this is in the money, if you have 1 day left, the underlying could probably, so if this is 100 and the underlying is at 120, so this is a 100 call, this is the underlying is at 120. So you expect the underlying to end up between say 117 to 123. In which case, if the market goes up, you make money. If the market goes down, you lose money. So there is going to be no time value. So therefore, time value of in the money options also decrease to 0 as you come closer towards expiration. And that is what we see in this graph. Time value reduces to 0 as you come closer towards expiration. Okay. So let us now look at the last Greek, which is rho. So how do you explain rho? I'm sorry, I don't have graphs for rho, so I somehow missed them. So while generating this presentation, so I'll just quickly explain it to you. The thing is, of all the Greeks that we have, rho is the least critical of all the Greeks. So rho is the least critical of all the Greeks because the sensitivity of option prices to change in interest rate is very low. But nevertheless, it's good to understand how does the sensitivity of options change with change in interest rates. Okay. So I hope I'm making sense so far, and let's see if people have questions and so on. Okay, so there aren't any significant questions, so I can take all of them at the end. Okay, so we were discussing rho. Now, if these are options on the stock, for example, or a commodity. Now, what happens when interest rates increase? Based on the risk-free arbitrage formula, the future value of a stock is F is equal to S e to the power RT. So basically, if the interest rate increases, you would expect the future value of something to also increase to be in sync with interest rates. So therefore, if interest rates increase, you would expect the future value of a stock to be higher. If you expect future value of stocks to be higher, then what does it mean? It means that the call option price should increase because the underlying price is going to increase with increased interest rate. Therefore, the call option price should increase. If the future price increases because of increase in volatility, you would expect increase in interest rate. You would expect the put option prices to decrease because the price of a put option will decrease when the underlying goes up, right? So therefore, when interest rates increase, when you have options which on stocks, the call option prices increase when interest rates increase. The put option prices decrease when interest rates increase. Now, a second point, when imagine you have two call options, a call option on a strike of 100 and a call option on a strike of 150. Which one do you think will have a greater sensitivity to rho? The option which is in the money will have a greater sensitivity to rho. Because they have the greatest cash outflow. Oh, sorry. So let us look at the case when you have options on futures. Now, so basically an in-the-money option is going to have a higher rho than an out-of-the-money option, which is understandable. Now let us look at the case when we looked at the case when the options are stock settled. Now what in case the options are future settled? In case the options are future settled, you only have to you only get the difference, right? So therefore the game becomes different now. So in this case, if you are holding options, it means that you are buying options means that you have paid money to buy the options. So therefore, if interest rates increase, the money that you have paid to buy the options becomes less worthful to you, because you have already paid the money and then you are not able to make use of the money. Because if interest rates increase and then you have already locked your money, you have already paid out money, so you cannot make use of the money. So therefore, if the options are on futures, in contrast to options on stocks, then both calls and puts have negative rho, which is increase in interest rate is bad for both of them. In all cases, the rho is more significant when you have a higher time to expiry versus a lower time to expiry. So basically it means that if you have, once again, take two extreme cases. If you have 1 year left to expiry versus 1 second left to expiry. If there is only 1 second left to expiry, even if the interest rate increases by 1 percentage point, it's hardly going to impact the underlying. But if the interest rate increases by 1 percentage point, if you have 1 year left to expiry, the underlying is going to end up way higher. So versus when you have only 1 second left to expiry. So therefore, options on stocks and the call options are going to become more expensive, and put options are going to become more cheaper when the time to expiry is higher. So rho, when time to expiry is high, rho is high. Now options on futures, when the time to expiry is high, once again you are losing out on the ability to earn interest for a much longer period. So therefore, time to expiry, rho for longer dated futures settled options is higher with a negative sign, versus options on longer dated, shorter dated options when the interest rate increases. So this is very quickly, a very quick summarization of how to look at how option prices change with interest rates. So let me now look at the question and answer panel. So let me now take as many questions as possible. So I believe that you guys can't see this Q&A panel, so let me so there are a few statements in French which I don't understand. Can we get a link to part 1 with the link to the part 2 recording? Yes. Yeah, I see that Cynthia has already responded to that. So we will try to put a link to part 2, part 1 as well to all the participants. Any presentation at video end? Okay, so Cynthia has already responded to it. So someone said use the whiteboard, please. So I'm not sure. Someone said that why is it muted? I think they had a technical problem. So someone said in weekly options, Vega has low significance. Yes, you're very true. So when you're trading weekly options, it's mostly gamma. So you probably trade Vega for the first 1 or 2 days and then shift towards Vega. And then in some geographies, you also have daily options, in which case the component of Vega is even lesser. Vega should increase with increase in Volatility, okay, we already discussed that. How can I ensure by continual adjustment option remains out of the money? So I think this is when we were discussing variance swap. So what we did was we took positions across the entire chain. The next question is related to variance swap. So I answered that. When we buy call put options with various strikes, don't you think theta come into play and eat away the profits? Well, that is very true. So when you buy options, you are paying theta. So basically, the trade-off is between the if the market moves, you make money through either Vega at the start of or Gamma. But then if the market doesn't move, you lose money because of theta. So it's basically a trade. Option trading is always a trade-off between Vega plus Gamma on one side and theta on the other side. So someone said that, sir, in variance swap, how are we making profit if we keep on buying options? Oh, nice question. So basically, we are not keeping on buying options. We just initiate a position at the start of the month, and that's it. So you see the Vega. Let me move the. You see the Vega of that portfolio. So the Vega of the portfolio is constant, irrespective of where the market is. So irrespective of whether the market is here, the Vega of the portfolio is like this. And even when the market moves, it's going to be like that. So therefore, what it means that you don't have to keep on buying options. You just buy once, and then if the volatility increases, you make a lot of money. If it doesn't, you don't. Next questions increase depends on theta. Okay. So I had those questions regarding 3 monthly expirations, and then people have answers to those, but then now all of you know what the true answer is. So someone asked, can I download the presentation? I think we do provide that. So when we were discussing theta, someone mentioned which strike. So when I asked how does theta change with time, so that's a very valid question. So we did discuss that. Someone has a very interesting question. So many courses suggest selling options, short-term calendars to exploit this phenomenon. Selling 1 week, buying 2 weeks. What do you think, and what are the risks? I would rather say that it would depend upon. Well, there is no free meal. So if you are selling, which basically means if you are selling near-term options, you are hoping that the drop in option prices because of theta will help you make money, and you are hedging yourself by buying longer-dated options. But then the drop, the amount of loss that you can have because of gamma could be huge when you're close to expiry. So the option prices could change drastically. So what you sold at 5 cents or even $1 could turn out to be $200 so on expiration. So the change in values could be huge. So therefore, you could lose more on gamma when you sell short-term options versus the gains that you make on Vega in the far-term options. So it's not, there is no, it's not a straightforward answer. Someone has a question, how can I use gamma and delta to ensure continual adjustment option remains out of the money? Well, so basically what people do is they calculate what the gamma of their portfolio is, and then based on that, what the delta of the portfolio would be at various prices of the underlying, and then based on them, they put their delta hedging orders and so on. So I think that is what you're referring to. So it's a, there are various ways to do it. You would say that what is the expected volume. So basically, what are the challenges? You might hedge too early. If you hedge too early, then you don't. So basically, okay, this is going to be another long discussion. So basically, when the underlying is at 100, you bought the 100 straddle. So you are basically paying theta, which is this loss that you make if the underlying stays at this point. But if the underlying moves, you're going to make profits. If the underlying moves here, you're going to make this much profit. If it moves here, you're going to make this profit. But when you do gamma hedging, well, so what you mean is, if the underlying moved here and then came back here and or moved here, you lost out on the entire opportunity to make profits, because it had once gone all the way till here, in which case your profit was here. but then when it moved back here, so even though you are true that the underlying will be volatile, because the underlying ended at the same price as the strike price, you make a loss of this much. So what you do is you do gamma scalping, in which case as the underlying goes up, you keep selling. And as the underlying goes down, you keep buying. Because if you are bought an option, you are long gamma. If you are long gamma, when the underlying goes up, when you're long gamma and the underlying goes up, you will get positive delta. Isn't it true? Because it's long gamma. The gamma by definition is rate of change of delta by change in underlying. If the underlying goes down, you will get negative delta. What do you do when you get positive delta? You sell options. What do you do when you get negative delta? You buy options. So what it means is, in gamma scalping, you try to sell as the market keeps going up, and you try to buy when the market keeps going down. And then you hope to do a lot of such scalps and make profit. But if you hedge too early and the market goes up a lot, then you've missed out on the entire ride, and then you have sold too early. So instead of selling here, you sold here, and then so that is the problem that you have. So therefore, you need to determine at what level do you want to sell your delta that you get from gamma. So that is the question that P.J. Lal had. So it's not a straightforward answer. It depends on your expectation of volatility. Based on your expectation of volatility, where would you want to hedge and so on. So it's a long conversation. Just explaining the basics behind this took quite some time. So you can understand how much time it would take to explain the intricacies of it. I assume that all your studies are based on a log normal distribution of the underlying price movements, correct? Yes. Is there a significant deviation from theoretical behavior in some of these in real markets? No, not much. No, not really. So is part 1 archived? Where can we get it? I think Cynthia can share a link with you. You can get, through which you can get access to part 1. Finished first part. Can I get both the parts combined video? Well, you can. So I think with that we have closed all the queries. So I will now let Arjun from the QI team to give a very quick thank you note and to explain about the QI course, which has some of these things in much more greater detail. So yeah, next over to Arjun.
Thank you, Rajiv, for that quick introduction, and thank you very much, everyone, for attending the webinar today. It was an amazing participation from all of you. I'm quickly going to explain a little bit about our course called EPAT, and this course is all about algorithmic trading for professionals and students, wherein we cover topics like options, Greeks in even further detail. So you can visit our website or call us on the mentioned numbers, and we do have an early bird discount going on till the 17th of September. So make the most of it, and I hope you can go ahead and enroll for the one. I believe so. So our next batch starts on October 28th. There's a slight mistake on that slide there, which states October 21st. So I'm going to hand over the controls to Cynthia. I believe she would like to have a quick word before she goes ahead and closes the webinar. Cynthia, are you there?
Yes, I am, Arjun, and thank you very much. I want to thank everyone from QuantInsti for the second in our three-part series on managing your options portfolio. We are in the process of scheduling the next one coming up in October, so please do watch our webinars page at the Interactive Broker website. We'll also be sending out a link with our October event. So please do watch and take a look for that. Now, I'm also do want to respond and make sure that everyone is aware that we have been recording today's event, and each of you will get a direct link to today's recorded playback as well as a link to the webinar notes. So you can watch and review the concepts that Rajiv discussed today whenever it's convenient for you. And by the way, one of our attendees today had asked that I also include the information from part 1. So that that will also be included in the follow-up. So do watch your please watch your webinar, your inbox for recording links to today's event. Well, with that, we are going to conclude our session today. I want to thank everyone for your participation with us here this afternoon. There's also, please be aware that there are some questions that will pop up as you exit today's event. I do ask that you take just a few minutes to fill out those survey questions. That really is helpful for upcoming information or upcoming presentations. Well, with that, we are going to conclude our event today. Once again, thanks to the folks at QuantInsti for a great presentation, and to all of you for your participation with us here today. You can exit today's recording by simply using the X in the upper right-hand corner of your screen. Thanks, everyone. Have a great day.